I do have concerns that we're on our way to a recession, right? Because you've seen the GDP now collapse from 4% to minus 2.8. So arguably, we're going to have a little, ugly setback in growth. Ultimately, I think we're in a place where the response is going to be massively good for Bitcoin, right? We're going to have to cut rates. We're going to have to increase the money supply back to high single digits, maybe even low double digits. And in that world, one Bitcoin's one Bitcoin, but we don't price in Bitcoin, price in dollars, so the price is going to go up.
Economic indicators now suggest that the risk of a recession in the U.S. may be higher than previously expected. Recent estimates from the Atlanta Federal Reserve's model show that GDP growth in Q1 of 2025 might turn negative, as the model incorporates new economic data. Although these projections are volatile and subject to change, they currently point toward a slowdown in economic growth. This is further supported by other warning signs, such as the reinversion of parts of the yield curve, where the 10-year government debt yield has fallen below that of 3-month borrowing, a historically reliable indicator of a recession. Adding to the cautious outlook, consumer confidence in February dropped sharply, according to the Conference Board. While the job market appears relatively robust, underlying hiring trends continue to trend downward, according to the U.S. Bureau of Labor Statistics. Furthermore, prediction markets like Key now estimate a 40% chance of a recession occurring in 2025, a figure that has risen significantly in recent weeks. Mark Yusko, CIO and managing partner at Morgan Creek Capital, believes there is a high chance the U.S. economy will slip into a recession in 2025, which would negatively impact asset prices. However, he remains confident that the decline will be short-lived, as both the U.S. and China are actively injecting liquidity into their economies to prevent a complete collapse. This includes China's plans to pump at least $55 billion into major banks and U.S. Treasury Secretary Scott Bessent's announcement of efforts to lower interest rates to address the unsustainable levels of national debt. Yusko believes this will lead to higher asset prices in the coming months, particularly for cryptocurrencies, which have significantly outperformed central bank balance sheets over the past decade. Before we continue with the rest of the video, do check out Daily 5-Minute Crypto Newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
For the support, and enjoy the video.
Macro can be summed up in a simple word, 2 simple words: money supply. Right? So money supply, which is actually why we're talking about all this other stuff, right? Why Bitcoin's so great. The money supply has been growing at a truly astonishing rate for a very long time. And it's because of, my generation, the boomers. The boomers create a bunch of entitlements. What's an entitlement? It's a promise you make to yourself that you don't fund, that you ask your kids to pay for. Who wouldn't vote for that? So the boomers voted for all these entitlements. And turns out the only way to get them was to issue lots and lots of debt. So we have this massive debt overhang, 36 trillion and rising. And then there's that T word again. So what does all that mean? Well, what that means is in order to service the debt, right, in order to create GDP when you have so much leverage, you have to increase the circulation of money. So money supply has grown about 8% since the creation of the Fed. And all this boils down to the difference between kind of real money, right? Money that doesn't devalue, and devaluing paper currencies, fiat currencies. So from 1776 to 1913, a dollar was worth a dollar. A little fluctuation in value around wars and depressions, but a dollar was worth a dollar. There was no such thing as inflation. So then the Fed was created in 1913. Well, why was the Fed created in 1913? Well, if you go all the way back, right? Who had the first world reserve currency? Portugal, interestingly enough. Well, how does little tiny Portugal, right, about the size of, New Jersey, have world reserve currency? Well, they had the fastest, most powerful navy, because they had the tallest trees. So they're the most, lethal fighting force, and they had the Knights Templar, and so they had the world reserve currency. Well, then the Spanish Armada overtook them, and they became the world reserve currency. And then little Netherlands, and it's about the size of Ohio, conquered the Spanish Armada. How the hell did that happen? They created the first central bank. They created a bank where they could literally print money out of thin air. Before that, money had to be earned or created or held. It was commodity-based, gold and silver. That's why Spain and Portugal explored the seas to get the gold and silver to plunder, to bring back, to have money. Well, the Dutch said, screw that. We don't want to go find it. We'll just print it. So they created this bank, and they funded a mercenary force which took over the Spanish Armada. Well, then Napoleon, who was a pretty good general, you guys have all seen the movie, took them over, and they had it for a while. Well, then some of the Rothschilds went up to the UK, and they took the model from the Netherlands and created a central bank in the UK, and they funded steamship technology, which defeated the French Navy, and then they were the world reserve currency. And they were the dominant superpower for, 70 plus years. The sun never set on the British Empire. And then in 1913, coincidentally, they invaded Mesopotamia, incurred a bunch of debt. The pound sterling collapsed. The dollar ascended. Over the next 31 years, we became the ascendant power. We were a little emerging market before that. And we had nuclear power. So our Navy has kept us the world superpower. But we also cut a deal in 1971 with the Saudis saying, look, as long as you price oil in dollars, we'll protect you, because that keeps the dollar the hegemonic world reserve currency. Well, now what's going on? Well, we did all this. We established the Fed. The Fed has been stealing 2% of our wealth or more every year. I mean, think about that. Who came up with an idea that over a 30-year period, half my wealth has been confiscated? That's not good for me. In no way is that good for me. So this idea of inflation, but it makes us feel good because our homes and our stocks and our stuff goes up. Like I live in Chapel Hill, North Carolina. According to Zillow, my house went up 50% in the last 2 years. But my house did not grow. It did not get more efficient. It actually wore out a little bit. I had to put money into it. What happened? The money got worse. And this is why Bitcoin is so awesome, and how it all kind of comes back to macro and ultimately China, is one Bitcoin is one Bitcoin. I do have concerns that we're on our way to a recession, right? Because you've seen the GDP now collapse from 4% to minus 2.8. So arguably we're going to have a little, ugly setback in growth. Germany's already in recession. Europe broadly is close to recession. Japan's always been kind of hovering on recession. We could be in recession. That's bad. And that's because global trade is drying up. Well, if that happens, there are going to be more margin calls. And in the short run, assets, even like Bitcoin, despite the strategic Bitcoin reserve, it could go down. Ultimately, I think we're in a place where the response is going to be massively good for Bitcoin, right? We're going to have to cut rates. We're going to have to increase the money supply back to high single digits, maybe even low double digits. And in that world, one Bitcoin's one Bitcoin, but we don't price in Bitcoin, price in dollars, so the price is going to go up.
Mark Yusko's prediction about the upcoming liquidity boost and its effect on asset prices aligns closely with Raoul Pal's Everything Code thesis, a macroeconomic framework that explains how liquidity, debt cycles, and central bank policies drive asset prices. The core concept is that global liquidity, primarily influenced by central banks and credit expansion, is the primary driver of market movements, rather than traditional economic fundamentals. Pal firmly believes that this will continue to be the case in 2025. In one of his recent tweets, Pal notes that with dollar rates and oil prices heading lower, and financial conditions easing rapidly, risk assets are likely to lead by a few months. He anticipates that this trend will create a strong second quarter for tech and crypto, with the positive momentum continuing into the second half of 2025. When asked about the potential weakness of the dollar allowing China to stimulate its economy, Pal responded optimistically, expecting China to take action in 2025 due to weak growth, deflation risks, and challenges in its property market. Powell expects the People's Bank of China to inject liquidity into the economy through interest rate cuts, government spending, and credit expansion to combat these issues. He believes that this stimulus will not only stabilize China's economy but also contribute to a broader global liquidity cycle that could benefit global markets, including commodities, risk assets, and cryptocurrencies, as well as tech stock. Let's return to the interview with Yusko for more insight.
Let's get back to Yusko's interview.
I'm 61. I'm the second to last year of the boomers. My wife's 60. Or no, she just turned 61 too. I'm about to turn 62. But we're the last 2 years of the boomers, and we've still got, a decade before we can take our entitlements. So you got at least another 10 years where you got to prop up that generation, because all of our wealth, the boomers, is in real estate and stocks. So you can't let those two things go down. And my guess is they won't. And so even if there's a short-term flush, which they're probably, Stevie Cohen's, pretty smart guy. I think there will be. Economic data are pointing to it. Leading economic indicators are pointing to it. So all that said, I think it will be short-lived, because I think the response from the U.S. government, and mostly from China is firing the liquidity bazooka like we've never seen, because they can't afford to have what happened to Japan happen to them. Because Japan, remember, in the 70s and 80s was the economic miracle. They were going to take over the world. We would send our people over to study under Japanese companies. And then they had a deflationary debt collapse, and they've been, moribund for 30 years. China can't afford that because they got too many people. So they are printing capital, and they're in a different position. They have more reserves. I think they have the largest reserves in the world, over $3 trillion. And so they have the economic power to recapitalize their banks, to, sweep the bad real estate stuff under the rug. And I'm sure you've seen the videos, right? Or if maybe you've even been. If you go to China, it's unbelievable. It's like living in the future. I mean, it's absolutely stunning what they have achieved. And I love the pictures where it shows, Shenzhen 30 years ago and Shenzhen today. It's like, oh my God, it was a field. And now it's this metropolis, like right out of a science fiction movie. Investors and investing has always been the same, right? Everyone should have three buckets. You have a liquidity bucket that funds your lifestyle, 5 to 15%. To pay the bills and pay the rent and travel and food. And that needs to be liquid. It needs to be high quality. It can't have lots of volatility. That's your liquidity bucket. Then up here, you got the 10 to 15% of the get rich bucket. And that's where I would say that's where you're doing the friend's condo deal, the brother-in-law's venture deal, the hot stock tip you got. You're going to lose it all, so keep it small. No, I'm just kidding around. But that's where you put, things that you think have big potential to return lots. And some of them go to zero, but that's okay, because that's where you take your big tail risk. Then 70% is in the stay rich bucket. Well, you say, well, what if I'm not rich yet? Well, then you got to have more in the get rich bucket, plus your income and plus your, you want to get some passive income. So, but that stay rich bucket, 70%, that needs to follow the endowment model, right? Which is a diversified portfolio of high volatility assets. And the younger you are, the more volatile, right? That are uncorrelated. I believe if you're under 65, it should actually be against the law to own bonds. Like literally, it should be against the law, especially in your 401k, because you can't touch your 401k until you're 71 and a half. So why would you put bonds in there? You should have venture capital and real estate and commodities and Bitcoin and all the most volatile things, because you can't touch it. Bonds are for the liquidity bucket to spend, nothing else. So in the stay rich bucket, you want to have an equity orientation, but equity doesn't mean stocks. It means private equity, real estate equity, commodity equity, stock equity, digital assets, not equity, but digital assets. Bitcoin should be a meaningful piece of that portfolio. Why? Well, because it's the perfect asset. It has 80 vol, which means it has a long-term high compound rate of return, right? It has the same vol as Amazon, and yet it has twice the compound return. Now, it's only been doing it for 16 years instead of 30. So Bitcoin's number will come down and they'll probably have the same, but they have the same vol. I use Amazon all the time. Amazon, every year for 30 years, has had a double-digit drawdown, including this year. It's in one right now. When was the right time to sell it? Never. But who bought it on day one and held to today? 5 people. Jeff, mom, dad, ex-wife, Bill Miller. That's it. Because everyone gets shaken out by the volatility. But the beautiful thing about a stay rich portfolio, by having uncorrelated assets, why Bitcoin's so perfect, why Amazon's so good, they're not correlated with one another. Bitcoin is 0.0 correlated to bonds and 0.15 correlated to stocks. So every time you add it to the portfolio, your risk goes down.
On Thursday, President Donald Trump signed an executive order to establish a strategic Bitcoin reserve, mandating a full accounting of federal digital asset holdings and prohibiting the sale of Bitcoin from the reserve. The order also creates a U.S. digital asset stockpile, managed by the Treasury Department, which will be funded with Bitcoin seized during asset forfeiture proceedings. This move ensures that taxpayers won't bear the cost, as the Bitcoin in the reserve is part of assets forfeited from criminal or civil cases. The executive order also establishes a digital asset stockpile beyond Bitcoin, consisting of other digital assets acquired through forfeiture proceedings. The goal is to responsibly manage these assets under the Treasury Department's supervision, with no additional assets being acquired. The U.S. government will not sell any Bitcoin from the reserve, marking a significant shift in how digital assets are handled by the federal government. In addition to the executive order, the White House is holding its first crypto summit on Friday, with influential figures from the digital asset space, including Michael Saylor, Brad Garlinghouse, Fred Thiel, Tyler and Cameron Winklevoss, and Brian Armstrong, expected to attend. President Trump will personally host the event. What do you think these developments mean for Bitcoin and the broader digital asset space? Share your thoughts in the comments below.